Thank you very much, and good afternoon, ladies and gentlemen. I am delighted to have the opportunity to spend this afternoon together with you talking about innovation. And I want to talk about the book. With academics like myself, you're always going to find that we're plugging a book. We're trying to sell books to you, and this one is called almost as the title session. Well, there you have the right also title of the book, which is The Innovation Illusion, How So Little is Created by So Many Working So Hard. It's a book that came out a few years ago, and it's a summary of many of my experiences being sort of a part-time academic, as you can see, wearing a bow tie and looking pretty academic, and part-time working and leading a consultancy firm in Europe, which is focusing on trying to understand what companies need to do in order to achieve innovation, and what needs to happen for an economy at large to achieve innovation. This book, in my talk today, started from what I believe to be an extraordinarily simplistic notion that we can find quite often in the broader conversation around innovation, which is this: that if we just add technology to a company or to an economy, magic is going to happen. You're going to see significant revenue growth for the company, significant value generation for the company. You're going to see that the economy itself is going to raise productivity, and as a consequence of that, gross domestic product per capita is going to go up. There is, of course, a partial truth to this story. And if we take the long sweep of history, this is also what we're going to find, that prosperity levels that we have today and prosperity growth that we've seen over a long period of time is fundamentally dependent on the way that economies integrates new technology into the economy, the way we use technology and other different types of additions to make us work smarter, make us use our resources in a way which is going to be smarter and free up time and resources for us to do other things. I mean, that is the essence of productivity and innovation. But my problem with the conversation we often have is that people think there is a mechanical, almost automatic process, that if you spend a lot of money on, for instance, research and development, if you have big departments of innovation in companies, or if you have large universities focusing on STEM sciences, you're going to see that the economy is going to grow as a consequence of that. All these factors are necessary but not sufficient conditions in order to get innovation. That is my point. And when I've been working for 30 years with different companies across the world, this is basically my main takeaway point, that when you look at these companies and you compare them to the peers in their sectors, you're most of the times going to find that wherever in the world that large multinationals come from, they are comparable in their capacity to work with new technologies. That is not what is the distinguishing differences between many of these companies. What is the difference between them is the capacity of these companies to basically run with this technology, change what they themselves are offering with this technology, and start to compete with themselves. That tends to be one of the most fundamental ingredients for generating a lot of new value added on the back of a lot of investments in research and development, or a lot of capital investments that you're going to do in your technology stock as a company. You need to be able to start to compete with your own products for all that type of investments to really change things in a way which is fundamental. Let us take a company like Samsung. 25 years ago, I was working quite intensively with two other companies that were competing with Samsung. One was called Nokia, and the other one was called Erixon. Do you know these companies? Of course, they're pretty big. Their valuation at that time was, I can't remember, but it was X times Samsung. If you, 25 years ago, were thinking about which companies in the world you think is going to make it really, really big on the back of a broad telecom revolution which is going to change fundamentally how we integrate with devices and data in the world, a lot of observers, a lot of investors back then thought that, well, I think Nokia and Ericsson are in a very, very good position in order to create value and to prosper on this particular development. If you look at the valuation of these companies today, they are far, far, far smaller than a company like Samsung. And they are not even comparable to what were the main competitors back then, especially if we start to run up to 2004, 2005 and look at a company like Apple, which came in. What is interesting with it is that all the products that Apple had in order to revolutionize the handset market and change sort of the telecommunication services market for private consumers, they were all known to Nokia and to Ericsson. Nokia started already in the late 1990s with a touchscreen device where you could use your fingers rather than the buttons on your BlackBerry or on your Nokia communicator in order to write things on your phone. They were trying to develop an app store in the late 1990s. It didn't work. Ericsson had products also using touchscreen methodologies for how to navigate your device. They developed something they called a cordless web screen that came in 2001. Well, the cordless web screen was almost sort of the exact product that we now call the iPad, which of course in 2011 became a strong revolutionary of the handset market when Apple started to introduce it. So the products, the technology, some of the key characteristics are what's going to be the fundamentally new products on the device market that will come a little bit later. They were known, they were developed by companies that were sort of strong in the market in the late 1990s, beginning of the 2000s. But we don't associate any of these companies with the big revolution that started in 2005 and of course accelerated pace with the introduction of the iPhone in 2007. Nokia and Ericsson are not companies at all that we associate with the consumer device wearable market at all today. They still exist, but they produce telecom network equipment. Now, what happened? What was the main problem they had knowing all these technologies, having these technologies on their own books, starting to develop products that would be similar to the ones that later was going to revolutionize the market? So they had all that. But they lacked one fundamental ingredient of success, which was they didn't want to compete with their own products because they already generated so much and prospered so well on the back on the products that were already selling. So if they were going to start to integrate, say, a touchscreen device for your mobile phone, that was going to compete with what they already had in the market, which was extraordinarily popular. Of course, a popularity which was exacerbated by the rise of BlackBerry in the same period. That we're going to use buttons on your telephone in order to communicate. The App Store itself, well, they didn't want to go ahead with the App Store because they thought that that was going to pull away revenues from the hardware and the handset market that they were trying to prosper from. So this is often the key characteristics which is defining the change between a company that are successful on the back of R&D and technology and a company that is not successful on the back of R&D and technology. Steve Jobs says, if you don't cannibalize on your own product, someone else will. And I think this is probably one of the most fundamental and most strongest wisdoms that we have from corporate development over the last 50 years. If you don't cannibalize on your own product, someone else will. So if you work for a company, it's your choice. And the choice is, well, either you are going to start to compete with yourself, or someone else is going to do it. And someone else is going to demote you from that throne where you may be sitting today. And if you lack that instinct, if you lack that killer ability in order to start to compete with yourself, you're probably going to find yourself that 10 years from now, you're not the one that consumers are going to go to when they look for interesting products. And it doesn't matter sort of the size of your R&D budget, the size of the quality of the human capital, because if you don't have that characteristics, life is not going to be good to you in the future. Now, this is basically the core essence of my book, which I'm plugging, which I wrote together with my business colleague Björn Weigel. We start the book with this man. He was an Austrian-American. He was born in Austria, just at that end of the Habsburg period. He fled to America after the First World War and started to work at Harvard as an economist there. His name is Joseph Schumpeter, and he's famous among economists as representing what we call Schumpeterian economics, which is basically an economics which is dynamic. We try to understand change. We try to understand what are the dynamics of change. How is an economy changing? On what ground is an economy changing? Now, Joseph Schumpeter called it creative destruction. Creative destruction. That's the formula for success, not just for a company, but for an economy at large, which is that if you want to change, if you want innovation, you need to create something. That's the creative part of innovation. But the other part is destruction. You also need to destruct something. Now, that may sound brutal, but the logic is actually quite simple. And the logic is basically this. If you bring something new to the market, something else needs to move. Something else needs to go away. Because innovation, at its heart, it's about change. And it's about how much change are you willing to accept? How much change are you willing to accept as an economy, or as a company, or perhaps even as an individual? I think it's a good question to ask yourself as an individual. Quite often, how much change are you willing to accept in your own life? I mean, now, when we look at the sort of the big changes that we see happening in the economy right now, we look at sort of the green revolution with new EVs coming with battery-driven electric vehicles. We'll look at artificial intelligence and how that's going to change, possibly, a pretty strong part of human capital. And if you, like me, are looking at this development and thinking, Jesus Christ, there may not be anyone asking for my services in the future. I may be outcompeted by a robot or by a computer. Well, then perhaps the real question you should ask yourself, so how much am I prepared to change as a result of new technology? Am I prepared to stop doing things I'm doing right now? Am I prepared, for instance, to leave my job and go to university again? Or take a break in life from the job I have, not necessarily going to university, but at least investing time in order to re-educate myself, to understand what this new technology is about and what I can do with it? Are you prepared to change a car from a petrol-driven or diesel-driven car to an EV? Accepting the consequences that, well, sometimes it may be a bit inconvenient to do it. But of course, for companies and for economies, these questions aggregate up to pretty big things, and pretty big things that they need to navigate and understand in order to be well-positioned for the change which is happening in the economy. And this was basically Joseph Schumpeter's main contribution to understanding these things, which is that when we look at sort of the broad sweeps of economic history, when we're trying to understand the fundamental generators of prosperity, yes, R&D-driven change in the economy, that is a necessary but not a sufficient condition. Because what you also need to have is a lot of entrepreneurs and a lot of companies that forces others to stop doing what they're doing in order to do something new. And that's a process which tends to come from new entrepreneurs, not from old entrepreneurs. It tends to be something which is easier to do when you start small and when you grow, rather than when you are big and you're trying to change. The business history is full of examples of companies, just like Nokia and Ericsson that I mentioned, that couldn't change because not just because they were prosperous in what they were doing previously, but also because they were big. It was difficult to change. If you take a company like AT&T or take a company like IBM, for instance, they were sort of the strongest companies that existed in the world in the 1980s. Now, today, they are hardly around anymore as notable international companies. IBM has the same valuation, stock valuation today as it had in 2012. It hasn't moved at all since then. AT&T has had its own problems, but it's still basically around producing telecom services, predominantly in America. It has a few other companies around the world that it owns as well. But these were companies that weren't capable of that change because they were big. They started from a position where they were not dominant in the market, but they were big, basically like the Googles or the Apples or the Amazons of the world today. And as a result of that, they found it very difficult to change. Some economists call this the monkey trap. And the monkey trap is basically this, coming from an experience, which is that if you take a banana and you put it into a coconut, and then you give it to a monkey. The monkeys take his arm, going to go into the coconut and grab the banana, but it can't get the banana out because the hole isn't big enough in order to get the banana out. But the monkey isn't intelligent enough to understand, I need to let go of the banana. I need to drop the banana because otherwise I'm not going to get my hand out. So they get stuck in the coconut. That's the monkey trap. And this is basically what happens also to companies like IBM and AT&T, which is that they were standing in that coconut holding that banana, which was extraordinarily attractive. And of course, for these companies, it were what they were selling already now. IBM was entirely hooked up to its basically main computer frame, which they thought was so impressive and generated so much value that they couldn't start to compete with it. They couldn't destruct it. So the markets and others did it for them. AT&T, basically the same thing. They were standing there in the coconut holding that banana, and for them, the banana was basically long-distance telephone calls, which was something which generated extraordinary amounts of revenues in the 1980s for them, and they couldn't let it go. That's the essence of Schumpeter's key message to us. Creative destruction. In order to create, we need to destruct. We need to let go of that banana in the coconut. Now, why am I calling it then the innovation illusion? Why do I think that we are problematically in a large part of the world on a track where innovation is slowing down? And this is, ever since I published this book, I mean, this is probably one of the most strongest reactions I've received most of the times. At one point, when I presented the book at a conference in America, I thought actually I was going to be punched in the face by someone who was very, very angry with me. And my basic message was this: we don't live in the most innovative times ever. We're actually pretty poor at innovation today. And when you read newspapers or when you listen to the broader conversation, that's of course what you would think. We're talking about the giant AI revolution which is coming. We have in the last 18 months seen significant change in the capacity of large language models in order to generate knowledge of a kind that a lot of people now begin to think is going to be superintelligence. When we look around biomedicine, telecoms, automotives, we're seeing, at least in the press, all this talk about the fundamental change which is happening. Perhaps it's true. But then I ask you, why aren't we seeing this change happening in our economic data? Because economic data is actually pretty good at tracking this particular change, and the book is full of economic data. Data and sort of curves which had a slope going up, 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 if all of this was true. But they aren't. Slopes are not going up, 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 up. We're seeing sectors where there are interesting developments. We are seeing sectors where there is an acceleration in change and innovation. But we're also seeing a lot of sectors where nothing has happened. They're moving sideways. And we're seeing sectors where we're actually going back, where productivity generation in these sectors are actually poorer today than they used to be in the past. We pay more in order to get a worse service than we used to do in the past. So there is variety. And there are sectors where things are happening, but I think on the whole, when we look at it, it's these four factors that I would like to propose to you as factors that are difficult for many economies today. Not all. That are difficult for many companies as they think about this particular part which I started with, coming back to Schumpeter, which is that adding R&D, adding new technology is a necessary but not a sufficient condition in order to get innovation. For innovation to happen, you need to have market change. You need to have new entrepreneurs coming in to contest markets and forcing older and larger companies to change. All right, the cost of new ideas is going to be my first argument for it. And I'm showing you, I'm not going to show so many charts because it just takes a lot of time presenting them, but I'm showing you a chart which goes from the 1930s up to the 2000s. And there are two different scales here. The first one is an index starting in 1930, looking at the research productivity. And then we have an index starting also in 1930, looking at the effective number of researchers. Now, what we can see here, we start with the green line, effective number of researchers. So starting in the 1930s, going up here, which is basically 23 by the year 2000, which is 2005. So we are basically 23 times as many researchers effectively in the economy today compared to where we were in the 1930s. Now, the important question, of course, is the blue line, productivity. The question here is, so all these new researchers that we have in the economy, what do they generate? What do they add? What's the economic output that comes from all these new resources that we are throwing into the economy? Well, we started in 1930 with index 1, and now we are there. And you can see what the value becomes if we look down there. We have seen an extraordinary decline of research productivity. Basically, the amount of value added that is generated for one new researchers that we add to the economy. Now, if we take different examples in order to look at this particular development, what I'm showing you here is Moore's law. You all know what Moore's law is, which is that the capacity of the chip is doubling every 2 years. He said every 18 months, but if you take every 2 years as the benchmark or as the algorithm for it, we can see, and if you look at the straight line here, it's almost spooky how mechanical and how automatic the capacity of the transistor or the chip has been in order to double its own capacity over time. But this, of course, has to be computed in light of what I talked about on research productivity. Because if you look at, in order to achieve a doubling of the transistor count now compared to in the beginnings of 1970, it's a completely different amount of R&D resources that you need to have in the economy or have in the company in order to achieve that change. So if we compare the number of researchers you needed in 1970s with what you need today, we can see that today you need 18 times as many researchers or as many R&D, sort of as much R&D capacity in order to achieve exactly the same change today that you wanted to achieve in the 1970s, which is to double the transistor capacity. It's nothing, I mean, this is the reality, which is that a lot of things is becoming more complex. A lot of things is becoming more difficult. When you look at the big technology shifts that we've seen over the last 200 years, of course, you're going to find that there is a cycle, and at some parts of the cycle, there will be plateaus, there will be accelerations, there will be decelerations, but it basically comes down to the point that, you know, when you're plucking low-hanging fruits, it's easy, but when you need to pick your fruits, which is higher up on the tree, it's a bigger achievement and a bigger effort in order to do that. So for many of the technologies we're talking about, it's perfectly natural that you need to add more resources in order to generate the same amount of output as you did previously. But that also gives us one of the reasons for why we may have a slowdown, which is that the slowdown of new ideas coming because they're costing a lot more. It costs a lot more in order to get new ideas into the economy. It costs a lot more today to achieve the equivalence of Moore's law in the broader economy than it did 20 years ago, 30 years ago, 40 years ago. And unless we're going to find new technologies that are going to help us profoundly in order to deal with this particular problem, the resource problem, when it comes to generating new ideas. It may be that we are going to have sort of a declining innovation rate more generally because the cost of new ideas are going up. Second factor, regulation and contestability. One problem that we can see in many economies is that it's getting harder and harder to step into new markets and compete there. That when you measure things like entry barriers to market, or when you measure things like the ability to compete in one sector, and then you want to take that into a different sector. So you want to have cross-sectoral diffusion of your own innovative capacities. That's getting more difficult. When you look at cross-geographical developments, basically having innovation in one economy and taking to the other economy, you're also going to find that we're gradually increasing the barriers to do that as well. It's becoming more difficult in order to have contestability. This is predominantly something which is happening in sort of in the old Western economies, especially in Europe and America, but also includes countries like Australia and New Zealand. A country like South Korea is actually moving in the other direction, which I'm showing you here when it comes to, you index these types of regulatory freedoms that I was just talking about, that from the 1980s up till today, you'll see that there is an increase in regulatory freedom. While at the same time, countries like United States, UK, France, Germany has largely been moving in the other direction, but sort of moving sideways for a long time, but moving in the other directions where regulatory freedom is actually going down. And this is not sort of general economic freedom or general business freedom. It's the freedom of how can I move cross-sector, across the border, in order to diffuse an innovation idea into other sectors or to other economies. One problem in particular, which is not captured by the index I'm using here, but that we can find is particularly problematic for new innovations today, is professional licenses, which is here occupational licenses. What I'm showing you here is a chart which is for the United States, looking at the share of workers in the United States that are covered by a state occupational license. And as you can see, there is a very, very clear slope of this particular development. Now, why is this problematic? Well, it is problematic because, and it's problematic not least in viewpoint of technology and getting technology in to fuse how we work with different services, because it's predominantly the service sector which is covered by a different type of occupational licenses. There are manufacturing sectors as well, but it's particularly the services problems. And if you have an occupational license which says that, well, in this state, I am authorized in order to work with new telemedicine technologies, but I can't do it in the state which is next to me. So you can be a resident or a practicing physician in a country like Florida, but you can't do this in Georgia or in Texas. So you get a limitation on human capital, a limitation on how can I take human capital, go across border to someone else and perform the exact service there. So that's one example of how different type of occupational licenses becomes a hinder on innovation, because you basically lock human capital into one particular geographic area. You don't get that cross-geographical diffusion as you want to achieve in when it comes to innovation. Third factor, which is uncertainty around frontier regulation. And frontier regulation here, I mean, when we have something new, when we have products or services that are new, technologies that are new, and we have old regulations. But regulators and politicians think, well, we need to adapt or we need to do things. But the question is, what are we going to do? So this is something that I think every major government is wrestling with in the economy right now. So how are we going to regulate high-risk AI? Are we going to regulate it at all? How are we going to regulate autonomous vehicles? Or if not autonomous vehicles, how are we going to regulate the insurance of autonomous vehicles? How is liability of insurances going to be allocated in the event of a computer crashing into a group of people and killing some of them? Who is liable? Is the computer liable? Is it the automobile manufacturer who's liable? Is it the algorithm developer who is liable? All these questions of liability are being dealt with right now, but they are uncertain, and that's the point. It's unclear what regulators actually think or what they want companies to do. Biomedicine is another example of it. My best example to it is when it comes to novel tobacco products. Now, we've been spending the past 70 years in order to try to avoid people smoking. Virtually every government in the world have had different type of policies in order to reduce tobacco, in particular smoking, in order to reduce the health effects and avoid that we have people getting ill, people dying too soon, or people occupying resources in the healthcare system. And now comes a lot of innovation here. A lot of innovation which leads to products that are much less damaging than cigarettes used to be. So we have novel tobacco products, and that can be everything from vaping to e-cigarettes to oral tobacco products. And we find governments all across the world confronted with these developments, and they don't know what to do. On the one hand, they want to restrict the use of tobacco products. On the other hand, they also understand that, well, you know, if you stop smoking and using this product instead, it's going to be a lot better for everyone, including yourself. They don't know what to do about tax system because they have taxed tobacco products for a long time. And now we need to introduce different types of incentives in order to move people from old tobacco products to new tobacco products. I don't know any government in the world that have come up with a good policy which makes it clear what they want businesses and consumers to do. What governments rather do is that they set competing incentives, and that they come up with definitions, product categories that are overly complex or that aren't applicable to the products that are being introduced on the market. This is something we're seeing across Asia, here in Korea, we're seeing it in Europe, and we're seeing it in America. Complexity in regulatory categories. GMOs, generative AI, large language models. This is something that Europe just has been going through, introducing the first AI regulation in the world. But when you do that, you need to be clear about what is the regulatory category. In this case, what is generative AI? What is it that we're going to regulate? No one knows for sure. So we come up with definitions that are ambiguous, and that leads to uncertainty. That leads to confusions about who regulates and who is accountable for regulations. Is it governments? Is it regulatory agencies? Is it the courts? And we can see that in many different frontier areas of change right now, biomedicine, AI, quantum, automotives, many different services sectors where there are things, new technologies that have been coming up, that governments are deliberately coy and creates uncertainty in the regulation because they don't really know what to do. Then they ask regulatory agencies to try to do the work for them, but regulatory agencies don't know what to do because they don't have a clear instruction from the government. So they also come up with strategies which are confusing, which often leads to the last part, which is that it's often courts that needs to define what you can do and what you cannot do with new technologies and new products that you are operating in the market. A counter example, which was pretty interesting, is what happened to the COVID-19 vaccines. I mean, imagine what would have happened if we applied all the pharmacovigilance regulations that exist on COVID-19 vaccines. They wouldn't have been on the market now. We would have to wait 6-7 years more before there were going to be a COVID-19 vaccine in the market if we applied standard medicine regulations to COVID-19 vaccines. No, of course, it went super fast. And it went super fast because what basically happened was that government was basically saying, we take the liability. We are now absolving you for responsibility for the product they're going to introduce to the market because we think speed is the essence here. We need to get these vaccines out, and we believe that the tests that you've done are already good enough in order for us to be sure that we're not going to kill people by, at least not many people, by giving them COVID-19 vaccines. So we think we can take the liability, you go ahead and just mass produce. And it gave us an example of what governments can do if they want to speed up change, if they want innovation to become and go a lot faster. Finally, and I'm going to end quite soon, the last factor that I'm talking about in the book is what I call grey capitalism, which is basically about someone like myself, whose hair is not just getting thinner, but also getting grayer, which means I'm getting older. And when I'm getting older, I'm getting closer to retirement. And when I'm getting closer to retirement, I need to save much more money for my pension. And all that savings I have go into different type of institutions that manage my pension savings. And when you begin to aggregate all these pension savings up, you're going to find that they are the ones that rule ownership markets today. That we have institutions basically managing retirement money, which adds up to a bit over $100 trillion in the economy, which are invested in different type of markets. When you look at the value of any stock exchange and what share of that stock exchange that is controlled by institutions, you will see that most large stock exchanges in the world have sort of almost 2/3 of the value is controlled by institutions. When you take big companies in the world and you start to look at who owns these companies, you're going to find that institutions are the major shareholders. They're also the biggest shareholders. So if you take a sort of any type of American company, you're going to find that the biggest shareholder in that company is quite often going to be Vanguard, BlackRock, or State Street. They all are going to be among the top 5 shareholders of that company. And when you compare their size of shareholding in that company with the biggest individual investor, you're going to find a very, very huge difference between them. That's not the problem itself. What I have concerns with is that these institutions, they are not entrepreneurial owners. These are not institutions that invest in a company with the viewpoint of having an idea how we can take this company to become even better than it is today. They are mostly investing on the basis of market developments and of sector developments. A company like Vanguard, if you take any sector in the US economy, they're going to invest in all top 5 companies in that sector. Their concern is not that one single company is going to outperform the others. Their concern is that all 5 companies are largely going to move in the same speed, in the same direction. That's their main interest. So when you look at the alignment of interest from investor down to corporate performance, you're going to see that the interest is not that one company should try to beat all the other companies because it's so much better, it's so much more innovative. It's that all companies should largely move at the same speed in order to have the same value generation for all of them. That's the reality today. And it's leading to an ownership of firm with the impulses from the main owners is not that these companies are going to start to contest markets, that they're going to start to compete with themselves, that they're going to come up with new innovations that will make their current products that revenue a lot of value, that they're going to make them and sort of invest in them for the future. That's not what the impulses that they are delivering. The impulses is rather to be cautious, to be defensive, to avoid taking huge risks. And what we can see in these type of companies is also that investment ratios are going down in these companies. They are investing less than they used to do. We also see that the ratio between investing in the company and its long-term future and basically handing money back to shareholders through share buybacks and dividends have been changing profoundly over the last 40 years, been going down, 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 which means that It's much more financialization of the companies that sort of rule that rather than an entrepreneurial idea of the company. So they invest less in the company, they tie up less capital in the company, and they try to use dividends and share buybacks in order to compensate for what is generally underperformance of the development of many companies. Another indication of this is that when you look at not just the American corporate sector, but also corporate sector in other parts of the world, that they are becoming net lenders in the economy. So this is not financial companies, these are industrial companies, where sort of, if we take sort of a very long sweep of history, this is going back to the 1960s, but if we go back even further back in time, we will of course see that corporate sector is a net borrower. In a typical corporate sector, you have an idea and you want to have investors, and investors are going to manage money from savers, so you borrow money from them. You borrow them from banks, or you borrow them from any other type of financial institutions. That's basically sort of how the capitalist system has been working for a long time, which is that you get people invest in stocks, in bonds, using the savings in order to do it, and then they think, well, there's going to be a value generation on the back of that investment, which is going to, not just going to get my money back, I'm also get a good yield, a good interest rate on the money I'm investing. But what we're seeing here in a development which has, of course, sparked from here, which is basically late 1990s up to now, which is that the corporate sector is being a net lender to the rest of the economy. And this is partly a result of the change in ownership that I pointed to, which is that they want to tie less capital in companies, and they take a lot of capital out of companies. But of course also by activities by central banks over the past 20 years, which has been extraordinarily active in generating liquidity into economy in order to help economies and help companies to survive periods of problems. We had it in the late 1990s with the sort of the tech sector crash in the late 1990s, which led to a lot of central banks starting to fuel the economy with liquidity. Then we came up to the financial crises in Great Recession in 2007-2008, when of course it was a huge boom in liquidity. Continued basically throughout the 2010s until we started to weigh down of quantitative easing policies in 2017, 2018. And then came a boom again with the pandemic, where central banks have been throwing a lot of liquidity into the market. And this liquidity goes into the corporate sector because the bonds you need to buy in order to affect the quantitative easing is basically that you buy corporate bonds. So corporates have a lot of cash on their hands, and what can they do with the cash? Well, they lend it back to the rest of the economy. This is my fourth factor for why I think we have a slowdown in innovation and a slowdown in change, that we're getting a type of ownership which don't give the impulses to companies that you should start to contest markets. You should start to cannibalize on your own products. That is too dangerous for these type of owners. These type of investors, they don't have an idea what this company is going to do itself in order to compete in the future. They don't take shareholder responsibilities because they can't really do that. And given the diffused interest they have, basically being heavily invested in every company within one particular sector, it's very difficult for them to tie their own fortune to one company, because that's going to undermine, of course, the investments they're doing elsewhere. Anyway, so in order to conclude, my basic point, and coming back to where I started, which is that innovation is really about change. It's not about adding a lot of new technology, a lot of R&D into a company or into an economy. That's a necessary but not a sufficient condition in order to get innovation. Innovation is about profound change. It's about stop doing things we're doing right now in order to do new things. It's something which applies to individuals, companies, and economies at large. And if you want to have a good bellwether indicator of where a sector or a country is going to go in terms of innovation, the best question is to ask yourself, how much am I prepared to change? What in my life am I prepared to just stop doing and take away in order to do something else? And if your answer to that question is going to be not much, then you're probably not going to find a lot of innovation happening in the overall economy either, because this is what innovation is about, fundamental change. Ownership matters, especially entrepreneurial owners. I find it striking how most of the new companies that have emerged over the last 10 years, which have at least rocked sectors and markets a bit and changed them a bit, they've all been sort of young company growing up, contesting markets, cannibalizing on what other companies have done in the past. And they have all been ownership-driven, have strong owners, strong entrepreneurial owners. There is not a shortage of an ideas itself, but cost of new ideas have been going up. And when cost of ideas are going up, we have to add more resources just in order to keep up with the pace of change we're having right now. More and harder market and product regulations make sectors less contestable. That's one of the lessons that we've seen from generations of new regulations that have happened that are about cross-sectoral or cross-geographical diffusion of new technologies, of new innovations, which is that these regulations slow that process down. And then we had the uncertainty in regulation about frontier technological change, frontier innovation. And the basic fundamental question there, of course, is that, sort of, can I sell this product? Am I allowed to sell this product? Am I not allowed to sell this product? Unless you have clarity on that one, you're not going to find that there's going to be a lot of money coming into your own investment. And this is something we can see, sort of, a lot of things which is happening can be defined by the sort of the future opportunity to actually market your own products. Right now, it's handicapping a lot of things in AI, it's handicapping a lot of things in biomedicine because of unclarity whether you can sell the product or not. Leading up to my final point then, which is that most innovative firms that contest markets, they have strong entrepreneurial owners. It's not grey capitalists that are the owners. That doesn't mean that grey capitalists can't change or that they are only going to be a force for bad. I think they can. But I think countries or economies that are heavily dominant by old companies that have been around for a long time need to spend a lot more time thinking about what ecology do I need to create in terms of new companies that can start to compete with the old ones in order to keep up the pace and at least try to contest what they're doing. Because if we get too dependent on old companies and we have not enough bottom-up, vibrant, entrepreneurial dynamic change, we're not going to find that these old companies are going to change much either. This is the lesson that we're seeing in many, many sectors today and in some countries. I live in Europe and I can watch it. I have sort of a front seat ticket to watching this particular development. If you take an economy like Germany, why is it so stagnant? Well, it's so stagnant because it's so heavily dominated by old companies that are not challenged or contested enough by young upstarting companies that comes and try to cannibalize on them. Why is it so difficult to have change in a country like France or a country like Italy? Same answer to those questions too. All right, ladies and gentlemen, thank you for having allowed me to talk about my book for you. Please feel free to come up to me if there's something you would like to talk, or if you want to challenge me on some things. I can also say that I'm in the process of updating this book, and a new version is going to come out in beginning of 2026. And I hope to be back to plug the new book back then. So thank you very much indeed.